welcome to Risky Science Live, U.S. Flood Risk Markets and Models. I'm Olivia Berkman, an editor at Risk Market News. And I'm going to have all of our panelists introduce themselves. Brandon, go ahead.
Hi, I'm Brandon Katz. I'm a meteorologist and climate scientist with Cat Risk. So I'm one of the original co-owners. So I've been here for about 10 years now. So I work a lot in the flood space where I cut my teeth. These days, we've been expanding more into other perils, severe convective storm, wildfire, getting into earthquake these days. So we are a cat modeling industry company. And yeah, excited to be here and talk a lot about flood, I would say, and some of the other perils as well.
Great. Go ahead, Matt.
Hey guys, yeah, good morning, good afternoon, depending on where you are, and thanks for having us. Matt Duffy, I'm the President and Chief Risk Officer at Neptune Flood. My career began in banking, actually, in financial services, and then moved into the insurance space with Neptune just over 5 years ago now. So we're an MGA, a managing general agent, based out of Florida, but serving 50 states and Washington, D.C. across, the flood peril.
Great.
Ross.
Thanks, Matt. Thanks for having me on this important panel, and really looking forward to the conversation. Farasali, Director of Product Management. I oversee the Moody's North America Flood Modeling Solutions and also the Wildfire Solutions. Just to ground where my perspective will be coming from, within the Moody's Corporation, we have two core businesses: Moody's Ratings, which is focused on evaluating credit risk, and Moody's Analytics, which is where I sit within the Moody's Insurance Solutions. And of course, we're focused on helping financial institutions, banks, insurance companies quantify and manage risk. So looking forward to the conversation today.
Great. Thank you all. And just a reminder to the attendees, you can use the live chat feature to submit any questions. Don't hesitate to send along your questions. We can, weave them into our conversation, or we can save them till the end. So please do take advantage of that and advantage of the expertise that we have here. So for us, I'm going to start with you, but I'd like to address this to everybody. What's the number one number or statistic from the past year that most changed your view of the U.S. flood market?
Thank you, Olivia. In a recent report we published, we found that the U.S. is exposed to anywhere between 375 billion to 1 trillion in aggregate uninsured flood losses. So this is from a range of extreme flood events. I think what makes this number so significant is not only the size, but really what it tells us is how much flood risk remains outside the insurance system. Because ultimately, when I think of it, right, if you can't measure risk, you really can't manage it. And if you can't manage it, you can't build resilience to it.
Great point. Brandon, what about you?
Yeah, I've got a couple numbers. I mean, I've been kind of immersed in this flood, inundated in this flood world, if I want to use a terrible pun, for a really, really long time. And I think one of the realizations that I've had in the last handful of years is really looking at the difference between pluvial and fluvial flood. Now, this is maybe a little bit crunchy, but fluvial being the river overtopping type flooding, pluvial being kind of flash flood. And when you think about what people have used for the last, 15 years or so as the NFIP flood maps, a lot of people have used those. A lot of industries, the utilities use them. A lot of insurance used to use them. And they really primarily model the fluvial component, unless you're in Florida and Louisiana. Why does that matter? There's a paper in 2022. I'm looking at so I'm looking at my left here to remind myself the right numbers. By Ton and Sajowski in 2022, looking at TC and non-TC flood claims coming out of the NFIP. 74% of TC claims were pluvial. 60% of non-TC claims were pluvial. So I think one of the things that we're learning along with our partners and our MGAs and MGUs and primaries is that the pluvial component of risk is one that's been underappreciated for a long time. And most of that is outside of the SFHA. And if you look at the other paper from the Natural Hazards 2025, only 1% of homes outside of the SFHA are insured. So there's a huge opportunity there. So those are kind of some of the numbers that make me think, there's a coverage problem. There's also a coverage opportunity.
Mm-hmm. Matt, go ahead.
Yeah, Olivia, you were never going to get one number when you asked this for a single number. I'll give you two. One is 75%, and 75% is the the number of sales, the number of Neptune sales over that time period that have been voluntary, so non-bank mandated purchases. And so, we've always focused as a business on how do we grow penetration rates, right? How do we get more people insured across the country? And this is a number that hasn't really changed over the last 12 months, but whenever I get the chance to display it and to say it, I will do, because it shows that through technology and through better information and better identification of risk, we can grow that pie, and we have been growing that pie. And the other number I'd put out there is 55,000, which is the number of licensed insurance agents who have created multi-factor authenticated individual login credentials within the Neptune system since December 1st. And that just shows me that the reach that we have now as a private flood market, the reach that we have to be able to get information out there to agents, and for agents to then pass that on to insureds and property owners across the United States, is large, growing, and it's we're at this point, really this turning point, where it's really, really substantial today. The number of people who are interested in private flood and interested in flood insurance in general across this country.
Great, thank you all. For us, Moody's reported in May that the flood insurance protection gap is 65% for a 1 in 100 year flood, and more than 70% for a 1 in 500 year flood. Can you walk us through how those figures are calculated, and what went into that analysis, and were there any findings that surprised you?
Sure, no, that's a great question. I think to give you some background, right? First of all, this was the first of its kind with one Moody's collaboration. So within Moody's, as I mentioned, we brought together Moody's analytics capabilities in terms of catastrophe modeling, and then also within the Moody's rating team, we brought credit expertise. And the objective was to try to better understand not only where the flood losses might happen, but how these losses could potentially propagate through the financial system, right? So what are the downstream implications? And this is, of course, the report you cited is publicly available. It's interactive. Users can go and essentially look by county and so on to look up the insurance gap at that level of granularity. But going back to the methodology, at a super high level, right, what we did is we compared two residential portfolios. The first one included the total residential exposure at risk of flooding. So that is potentially insurable. So, think of it as regardless of whether, these properties or homes have insurance or not. We call that the economic exposure database. And then the second database we looked at was the insured exposure database. So this is representative of the National Flood Insurance Program. The reason we selected NFIP because, and I'm back, I think going back to your point, we've seen significant growth in private flood insurance, Matt, right? But then NFIP remains the dominant provider of flood insurance with about 4.5 million policies. So that's really the portfolio we looked at. And eventually what we did is we run both portfolios through our Moody's RMS Flood HD model, and we evaluated return periods, including the 1 in 100, the 1 in 500, and also looked at a future projection of 2050. Now, eventually what we did is we quantified the resulting gap at county level. So we simulated the 1 in 100 for every single county across the contiguous US, and then we aggregated. So when we talk about 375 billion or up to $1 trillion, this is really not coming from one flood event, right? This is at the county level and then aggregated it at the national level. And I think, Brandon, you made a great point about the Pluvial, right? So Pluvial is a really important component. What this analysis included was storm surge, so as you saw with Hurricane Sandy or other important events. And it also included fluvial river overtopping, and it also included the pluvial component, which is a very important one because, of course, it's highly unconfined. And then, of course, wherever it rains, it could flood. And at that point, it's going to depend on the stormwater system design and so on. I think, and to your point, one thing that resonated with me, right, is that the low insurance take-up rate does not mean low risk, right? And I think that was a key aspect that resonated with me. What also resonated was we saw that the concentration of, I would say, about 2% of these counties were representing over 65% of the aggregate uninsured loss. So that's another important number that resonated with me. And again, the magnitude on the concentration was very important. I think all this, again, re-emphasizes the importance of quantifying risk or flood risk comprehensively, rather than just looking at backward-looking information or historical data.
For us, if I can just jump in for a second, as part of that analysis, did you try and break it out between underinsurance and uninsurance? So those properties that, because you were looking at the NFIP portfolio, the losses were above the coverage amount available to them through the NFIP?
We mainly looked at the NFIP, so that was the the 250K limit and 100. But yeah, definitely there is more on the conservative side because we're not looking at the excess of NFIP. We can, but this is more first iteration, if you will.
Yeah, and I think one thing I jump into, and I think about what are the downstream effects of whether you have enough insurance. Like, you might say, well, a single homeowner might then lose their house. That's terrible. That's bad. Of course, it's bad. But I think one of the studies that we did a couple years ago with our partners at Milliman is we wanted to see, like, what is the actual credit risk? What does it actually mean when your home is underinsured? And so what we actually found from that study, running a credit risk default model as an example, was, I'm going to try not to throw out too many numbers here because I don't want to get in number salad here. But you had about 3.5 million homes that needed really significant repricing. So if you're a realtor or if you're a person with an investment portfolio, that means that houses that don't have flood insurance, there's a huge risk that credit could default. There's a huge risk that those locations, even if they're outside of an SFHA, and those are the 100-year return period flood zones from FEMA, by the way, if those don't know, that there's a huge risk that those property values are likely inflated, because there's also a huge risk that they could have a flood and that person has to walk away because they don't have any way to recover those losses. So that's why insurance is really important inside and outside of SFHAs. And then if you think about, let's say you add climate change to that as an example. So our study found that by the year 2050, for the high climate change scenario, it's RCP 8.5 for those that know these fun things, that the risk of mortgage defaults can rise by as much as 40% in the study that we did. So again, insurance isn't just, it stops at insurance and it's at the individual level. We could see a huge issue if we don't increase the amount of insurance and increase that and actually close that coverage gap to our GDP and really to the home values. So it spreads outside of the insurance into the realty market. And once you hit the realty market, you hit other markets. So there's this issue and this concern around flood modeling and flood mapping and making sure you know where your risk is and where your risk is not, and that you're working with people like Matt to make sure that you're getting properly insured. It's really important, and it affects more than just the individual homes. It affects the U.S. at large.
Thank you all. For us, as you said, one of the most cited findings in that report is that fewer than 2% of U.S. counties hold 65% of the nationwide uninsured exposure in the 1 in 100 scenario. Most people still carry a mental map of flood as a Gulf and Atlantic coastal story. What does the concentration tell you that the conventional backward-looking view of flood risk misses? Where on the map does it point that people aren't looking?
Yeah, that's a good question. And again, the maps are available online in the public report. But I think what the concentration maps told us that essentially that the uninsured flood exposure is both highly concentrated and more geographically widespread than in only these coastal areas. So when you think of it, it's really not only for specific counties. It's not only constrained to coastal counties or counties with riverine or floodplains that are prone to flooding. I think if I close my eye and imagine like in the map of the U.S., I see that there are some counties that have potentially darker blue, which potentially have some take-up rate, but everything else, inland, other states, has really a single-digit take-up rate, in certain cases less than 5%. Take-up rate here essentially means how many properties have insurance. So if you have, 100 homes in a specific area, 20 of them have insurance, then that's 20% take-up rate. So that's number one. And I think what was also interesting, right, is that when you look at the take-up rate map and you see the take-up rate being very low, the question we were trying to understand is, why is that take-up rate very low? Is it because the risk is low? Is it because there is risk, but the exposure is very low, right? So you could have, an area that doesn't have any exposure, rivers overtop, but, it's just overtopping and, water coming back within time. Is it potentially that, homeowners have not experienced flooding recently, or is it just that the risk is not, fully recognized, if you will? So I think the answer was it's more of a combination of many of those factors. A big important element, of course, is the binary flood maps or special flood hazard area maps. Those are binary, and of course you're either in or out. So from a probabilistic perspective or from a fully fleshed modeling perspective, it's a completely different picture when you think of it that way. So I think the key takeaway was really that when the insurance penetration is low and risk awareness is potentially going to be limited, and the protection gap could be potentially larger in many of these areas that we never realized or never had flooding before.
Right, thank you. Brandon, you touched on this a little bit already. Cat Risk has put out some research that argues that the National Flood Insurance Program's challenge today is not that the program failed, but that the nature of flood risk has evolved past the framework. Can you explain that further?
Yeah, I mean, the NFIP, it's been around since the 1970s. I would say it's evolved a lot, going from, I would say, very high cost flood modeling. Typically what they would do, the average was about $1 million per 5 miles of river reach. So they were trying to actually model all the rivers in the United States. And that's why when you look at the National Flood Insurance Programs, A zones and V zones, which are the 100-year return period flood, A zones, and the 100-year return period surge, V zones, that tells you again that in or out that Faraz was talking about. So for the longest time, what they did was they would take those maps. If you buy a mortgage and you have a mortgage, you determine are you in or you out. That's the Faraz's binary comment he mentioned. If you're in, you got to buy flood insurance. Now, how do they price that flood insurance? It's a fairly antiquated methodology that was really developed a very long time ago. In 2016, 2017, we started working with the National Flood Insurance Program, and they decided they wanted to adopt more of what they would call an actuarially sound. So essentially, what is everybody else in insurance doing, which is using CAT models, and also using actuarial standards and these kind of things. So some very strong scientists, some very strong actuaries and statisticians in the NFIP started working with CAT models. They work with us. They also work on some of their reinsurance buys with Faraz's company and a few other companies. And so they really started to use and move into a new framework where they're underwriting using very much modern tools. The problem where they're still stuck is that the mandatory purchase requirement, are you in the A zone or V zone, still exists. So what's interesting now is they decide if you have to buy insurance for your mortgage based on an A zone or a V zone, but they price your insurance based on an actual CAT model, which, as we mentioned at the top of the call, draws outside of the lines. Think about coloring outside of those A zones, because again, they're only modeling outside of Florida and Louisiana. They're only modeling the pluvial component very, very occasionally, or really just in those two states. So the actual underwriting is using a CAT model that has flood wherever there could be flood. All those areas that Faraz was talking about where there's flood risk, where people don't think about it, and where you're not mandatorily required to purchase it. So it's really, and it takes an act of Congress to change that. So you might say, why did they bifurcate the system? It's because there's not a lot of appetite to draw the eye closer to the government right now when it comes to FEMA prices and these things, national flood insurance prices. So I would say that they've moved past their framework. They're using a now actuarially sound methodology. They're still a little bit hamstringed what they can and can't do just because of the political realities that they live in. If you tell someone that their premium would increase by 50%, you call your congressperson, you might want to get that changed. But they're starting to move in the right direction. But what that's really allowed is the proliferation and I would say expansion of how the private market can get into these things. The private market has done a really extreme, just a very good job of going in and being able to offer, especially after the recent, I shouldn't say recent now, I'm getting to be old, but now the quite old Biggers Water and HFIA laws that changed that said that you can now provide an NFIP or better policy to homeowners. And that was really the rise of folks like Neptune, as an example, came up sometime around then, maybe a little bit before that. They began to supply some of these insurance policies. So I believe the number these days, Matt, you buy better numbers than me. I think we're around 4 to 5% of homeowners have private flood insurance. 95%, I think, roughly is still NFIP, if I recollect. But maybe Matt, I saw you come off mute for a second. Maybe you've got some better numbers there.
Yeah, I think the private market is a slightly larger slice of the pie today. We're at least double digits there, but just to add one comment to what you've been saying there, Brandon, as an industry, we're, incredibly blessed and lucky to have people like Faraz and Brandon working in this area, right? We've got some incredibly smart people focused on this today. And the fact that we still have this dislocation between known risk, right, the risk that we know as an industry and the risk that the government knows, and the risk that we're actually telling homeowners and property owners across the country, because the only way that 99.9% of Americans understand their flood risk is through, I've purchased a home, am I in or out of these binary zones? And the fact that we still use legacy information that we know to be incorrect to communicate that, is indefensible, and it's something that we have to fix as an industry and something that we're working on fixing. So to Brandon's point, the private market, the private, flood insurance providing market is focused every day, and the reports that, Moody's and CatRisk put out are really, really helpful in distilling that information to insureds and to agents across the country and to property owners. But there's got to be a directive here that makes it, more sound of an approach and sort of more widespread information that we get out there.
Yeah, there's also a squeaky wheel gets the cheese sort of argument here, if I want to use my fun Southern turns of phrase here. But if you think about when was the last time some of these FEMA flood maps were updated? If you go to Florida and Broward County, where people are very litigious, those are some very updated flood maps. If you go to San Francisco or the areas around the Bay Area, some of those flood maps haven't been updated since the 1990s, 1980s. And so your mileage varies when you're relying on some of these, sometimes not just out of date, but I want to say criminally out of date, but incredibly painfully out of date maps that are based off of data that just doesn't exist anymore because it's no longer cromulent. Sometimes rivers courses have changed. So again, just going to what Matt's saying, using modern tools is important for a lot of reasons, but sometimes the risk is just out of date, and that's why using the modern tools are really important. And I think the private market's done a really good job being agile to adopt new methodologies and new models.
Maybe another anecdote there, Brandon. I think you really make a good point about outdated maps, right? I think of it in New York City, where my office is based, is after Hurricane Sandy in 2012, FEMA issued preliminary flood maps for New York City. Of course, the maps were appealed, and in 2016, New York City won that appeal. And since then, these maps have been in appeal, so it's over 10 years now, and we don't have updated maps in New York City. So from a flood insurance rate map, what is used currently in New York City is the 2007 rate maps prior to Sandy. So that's another source where you have potentially some of these areas that could be at risk but are not showing in these maps. But of course, if you want to go and get, let's say, a building or something like a new construction, then you would have to use the 2015 maps that were appealed. So there's two sorts of maps today. That's another example of going back to your point, Brandon, in New York.
That's so fascinating. Matt, I'm going to move on to you here. Neptune's now the largest private flood insurer in the United States. The company has over 230,000 policies in force and is approaching 300 million in premium across 49 states. Looking back, what was the real competitive advantage that made the model work?
Yeah, so we just had our earnings call this morning, so I'm happy to update some of those numbers. But yeah, we have over 315,000 policies in force today, and over $400 million of premium, and so I would say as far as Neptune is a reflection, there's been some really strong growth within the private market. But I think sort of the story of Neptune goes back way before Neptune was even born, and the management team here at Neptune used to own a bank based in Florida, and so we saw flood risk and we saw flood insurance and how it works and the inefficiencies of the process from the lending side first. And banks in this country are used to police the implementation of the flood insurance regulations, right? Banks are the ones who, Brandon mentioned earlier, if you're in a special flood hazard area, you have to buy flood insurance. Well, it's actually if you're in a special flood hazard area and you have a federally backed mortgage, then you have to buy flood insurance. So look, these regulations aren't there to protect American homeowners, they're there to protect banks and the banking sector. And over time, they just haven't evolved at the same sort of, rate as replacement cost values have evolved and the, insurance market in general has evolved. And so We saw this from the banking side, from the lending side, and said, look, you've got this hugely inefficient market where you've got a government monopoly and a government balance sheet that's just been used inefficiently, right? The government balance sheet should be used here, but it should be used for that slice of risk where the properties can't be efficiently priced within the private market, right? We can't find a good way to price them or a reasonable way to price them within the private market. And so the whole idea was, how do we step in with technology, with talent, right? How do we bring different people to look at these problems, just like, you know, Cat Risk and Moody's and the other guys on the call today? How do we bring different talent to have a different view of this? And purely through technology, right? We're a technology company. We are not an insurance company at Neptune. We don't hold any insurance risk, so we're a technology company. How do we use technology to increase the reach of flood insurance and make it available to more agents, make it super, super easy to use so that it can be put in front of and conversations can be had with property owners across this country, and we can grow that penetration rate. We can grow the, shrink the underinsurance rate.
So, as you said, Neptune's mission is closing the flood insurance gap. Frost's report estimates that gap at anywhere from 375 billion to more than $1 trillion. And Brandon's research suggests that the highest risk properties may never be viable for private insurance. Where do you think the closable portion of that gap is, and where do you think it isn't?
Yeah, let me tell you sort of how we think about it. So there's over 100 million buildings in the United States today, and if we put round numbers on it, there's something like 4 million flood insurance policies that exist today. And so we've got, again, very round numbers, a 4% penetration rate. And even if you look at states like Florida and Texas, you're not getting above 12, 13% penetration rates, even in these extremely high exposure areas. And so there's this, huge gap today in terms of insured properties versus uninsured properties. At Neptune, we process around 25,000 quotes a day. So we have a lot of distribution, partners who are running quotes through Neptune every day, and we process around 25,000 quotes a day. And we say no about 5% of the time, just under 5% of the time. So if we look at our data sets that we've been able to develop over the last 9 years now of running the business, we've seen the vast majority of properties that exist across this country, and we've been able to underwrite those and see, okay, where would we offer a price? Where would it be beneficial to have those policies within the portfolio, and where would we not? And the answer is 95% of the time we say yes. And if you look at the flip side of that, around 50% of the NFIP's losses historically have come from about 2% of their policies. And so there is a tail here that is responsible for the vast majority of the losses within the flood insurance space. And because of that, and because of the technology that we have and the models that we have again today, we're able to identify that tail. We're able to identify it really, really well. And then because of that, we can determine the right balance sheet for that to sit on, right? And so that tail should sit on the government balance sheet, and that is a really good use of government capital and government funds, is to provide coverage for very high risk properties across this country. And then the rest of it, right, the 95% of homeowners across this country that can be priced within the private market can be done so on a more efficient basis, right? The private market generally, outside of flood insurance, right, the private market is there to operate efficiently and price efficiently. And if it can, it will be competed away. And so there's tens and tens of millions of properties in this country that are at risk of flooding, can be priced within the private market, can receive coverage there, and can do so at a very, very competitive rate generally and relative to the National Flood Insurance Program as well. And so I actually agree with both of the stats, with Brandon's stats and with Faraz's stats. There's a lot of underinsurance today. There is a tail that's very difficult to price today and to take into the private market, but it's small relative to the size of the overall market.
Great, thank you. So we've got a question from the audience. How much of private flood's growth so far is genuine new capacity versus selection against a subsidized NFIP book?
Yeah, it's one of my favourite questions to answer, and our best estimate of Neptune's portfolio today is that just over 80% of our portfolio is net new to the flood insurance space. We have been poor to medium at winning policies from the NFIP, right? Number one, because that's not our business model and that's never where we try to go. And number two, because as you mentioned, there's been such heavy subsidization on that portfolio over time. And so the NFIP, the National Flood Insurance Program, released their new risk rating methodology that Brandon walked through earlier back in 2021. And according to the Government Accountability Office, it's going to take until 2047 for all of those price changes to come in. Okay, so 26 years for those price changes to come in, because there's congressional caps at 18% a year for the price increases that can come through. And so there's a huge amount of subsidization that sits on that portfolio today. The GAO, Government Accountability Office, estimates about $1.5 billion of subsidization today. And so it's very difficult for the private market to compete with the NFIP as it sits today. And so we believe that the vast majority of Neptune policies, at least, now I won't speak for the rest of the private market, but Neptune policies at least are net new to the flood insurance space. And I'd just add as well, this has been a really difficult time to grow a private flood insurance book, or to grow any insurance book over the last, call it 5 years. Not just because of all the micro factors that we're talking about here and that we've mentioned, but because of the macro factors. If we just think about the flood insurance requirement again in the United States, you've got to have a federally backed mortgage and be in a special flood hazard area. But with interest rates where they're at, the number of properties that have mortgages in this country has declined significantly over the past 3 to 5 years. And so the number of homes that are owned in cash and aren't required to purchase flood insurance has gone down, right? So that results in people, dropping coverage. And at the same time, because of the high insurance rates, you have less churn, less turnover in housing. And that's the point at which people purchase property insurance within this country. So the number of at-bats, the number of purchasers generally, whether that's homeowners or flood insurance purchasers, has been down at the same time. So I'd say we're at this artificial low, cyclical low within the flood insurance purchase, cycle that we go through. But even at the same time, I think there's been some really good growth outside of the historical, NFIP pie, if we think about it that way.
Yeah, and just to add one point to that, I think that the question around what's NFIP versus net new, there's also then the question that would come up is a lot of the clients that I work with and talk to, around 90 or so clients, a lot of them are doing excess NFIP flood. So traditionally back in the day, 250K was the maximum limit. I forget if that's changed now today. I should know that, but I don't remember. Someone else will probably jump in. It's still the same. I thought it was, and so that hasn't changed in how many years, and what's happened to home values. $250,000 can get filled up pretty fast in an insurance tower. So that's why there's been a huge proliferation we've seen of excess NFIP claims where your deductible or you start coverage, where the NFIP leaves off, and then you go above that. So it's a complicated picture, but those interactions are important to know too, because in some ways NFIP is still kind of owning the worst part of the risk, right, at the bottom of that tower. And then we've been able to sort of subjugate and provide people that additional cover above there as well.
Yeah, maybe also to build on that, right, Brandon, I think when I look at the numbers historically, going back to your point, Matt, right, in 2009, we had about, 5.6 million policies with NFIP. That was before Sandy and Harvey, right? Today we have about, NFIP has about 4.5 million policies. So that's, from 2009 to today, 17 years, we've seen a drop of 1.1 million policies. And I think, Matt, that goes back to your point a little bit in terms of mortgage requirements, in terms of affordability and so on. So there's an element here. There's potential also mitigation happening, right? And also I think another interesting number when you look at the NFIP portfolio, right? They had what, $88 billion in losses, since the 80s or so. It's really driven. 50% of these losses are driven by 5 or 6 events or so, right? You have Katrina, Harvey, Sandy, and Helene, Milton, and Ian. So these are really the large 5 or 6 events that drove about 50% of the NFIP losses, right? So that's another, I think, anecdote. But I think to me, right, when I think of it, right, it's not whether, if NFIP is growing or shrinking or the private market is growing faster. I think it's just going to come down to resilience. It's going to come down to awareness and the pace at which we're keeping up with the risk. And also, I think this is where I personally see the value of better understanding the risk, because as you better model it, you better have insights. Maybe it's an area that didn't have flooding before, but is vulnerable to flooding, and we just don't know about it. And I think this is where we see a lot of value.
Great, thank you. And thank you for the question. Keep the questions coming. When a flood model gets updated and the indicated losses move by 20%, 30%, sometimes more, what does that tell us? Does it tell us that the underlying risk changed, that the model got better, or that the model was wrong before? Firas, maybe you want to start as the
Yeah,
model owner.
happy to start. And I think it's a really good question, right? Because sometimes it's the risk evolves, right? We see change in the risk in specific regions. Sometimes it's also genuine learnings, right? From events like Katrina, for example. This is where storm surge was a dominant, I would say, driver of the losses. We had banks or levees overtopping. Harvey, for example, I think going back to your point, Brandon, in terms of the contribution of non-tropical cyclone or rainfall to tropical cyclone events, right? Harvey and Hurricane Harvey had over 50 inches of rainfall. 90% of the losses from that tropical cyclone event were driven by rainfall. To me, when I think of it, right, a model is an imperfect representation of a very complex system, right? It's not a crystal ball. It's not going to tell us what's going to happen in the next year or so. But I think also what's interesting is the underlying science or physics has not changed. I used to teach these equations when I was in academia. I did my PhD on that, and one of the famous French scientists, Saint Venant, he used to live very close in an area where I lived in France. And in 1843, basically, he solved the Navier-Stokes equations and came with something called the shallow water equations for open channel flow. So that's been over 150 years ago, and after that we had Manning's in 1889. So history is good, and we've been solving these equations over the last 150 years. I think what changed was the way we solve these equations, right? The way the computational power that we have, the better data that we have, better digital terrain models, better claims experience, and again, genuine learnings from these events. And I think also more detailed property information, right? I think, Matt, this is something I'm sure you guys look at, right? Which is, well, yeah, this property could be at risk potentially, but it's maybe built to a significantly higher first floor height. Maybe it doesn't have a basement. Maybe it has some local flood defenses. So that could be a big differentiator. And 10, 15 years ago, flood models generally didn't have that granularity to capture that information, and that has evolved significantly. And I think also, to answer your point about the range of change in models, sometimes it's highly non-uniform, right? You can see certain areas where you see the loss increasing or decreasing depending on mitigation measures, right? And also we see significant differences between what we call the industry level exposure versus a specific portfolio, because the portfolio could be concentrated in an area where they are lower risk or higher risk, right? But eventually I think it all comes down to transparency. When we're updating a model, clients, the first thing they want to understand is tell me first of all, what is changing? How is the hazard changing? How is the vulnerability changing? And that's before going into the loss, right? So I think to me, this greater transparency can turn a lot of that uncertainty into something that we can potentially better understand, better manage, and of course, price more effectively.
Yeah, I think me as another model provider, I would say I would actually challenge the question a little bit. I would say that if all things being equal, let's say that you're holding where locations are static. If you're holding vulnerability static and you're just changing, you're updating your underlying data. If you're seeing a 20 to 30% difference at the country level, there's probably something bigger going on. Like we don't see those huge changes, I would say, at the country level. And I used to work at Firas's organization. I don't remember seeing them when we were there either. So I think, it's really getting down into the nuance of the models and understanding what can change in the models. So it's really what Firas said as an example is, Let's say that you now have a lot more information. I mean, geocoding is a great example, actually. Think about geocoding. This is like, again, getting into the minutia of models. But back when I was first working at RMS back about 10, 15 years ago, I'm sorry, Moody's now, we had TomTom data. So if you wanted to know where was your house, you would use TomTom, which was the data from, those old GPS machines, and it would tell you where you were on a street, right? It didn't tell you the rooftop, it told you the street. And so that's how you got your geocoding. I give you my address, I give you that long. Models are now so strong and so good that we're modeling at the 10 meter by 10 meter or 30 foot by 30 foot resolution. That means the streets flood first. So the difference in loss between geocoding on the house rooftop versus geocoding to the street can be hundreds of percent, actually. And so I think if you're seeing these large model changes, it's more a garbage in, garbage out question. It's more what's the data and how good is the data that you're getting. For us touched on this, of course. But I just want to make that wider point that if these models aren't shifting your 20 or 30% because the underlying science and physics are bad, it's a lot of times because the data that we're getting has improved. Now there are some situations, for us mentioned the digital terrain model, it's essentially your elevation. So like, where are your dips, where are your valleys? I've certainly seen some areas change very significantly, and you've seen some big losses and change. Some big changes in loss. And that's not because the physics are wrong, that's because the data that we got from the USGS and other places from the government has gotten better because they've gotten better data. So I would also and the reason I want to mention that is that this audience that we have, I want to make sure there's some confidence in the models. And if you're seeing a 20 to 30% loss, then we should be really deeply questioning the model vendor, the model that's being used. And hopefully the answer is something like, hey, the data has just changed. We're not geocoding the street anymore, that's flooding. We're geocoding the rooftop. Back in the day when we were just doing wind modeling or earthquake modeling, it didn't really matter whether you're on the street, whether you're in the house. Flood, it matters a great deal.
I'm not going to be able to give you any better information from a stochastic modeling standpoint than the other gents on the call here, but if we just take a step back, the hazard is changing, right? At the same time that the models are changing, the hazard is changing, right? Independent of what the cause, or no matter what you think the cause is, sea levels are rising and sea temperatures are rising at the same time. And so the hazard is changing. The models are continuously getting better and more granular, to Brandon's point as well. And so, you do see changes in sort of what I call view of risk over time. But if we flip this whole thing on its head and say, well, what if the models are changing and the hazard is changing and you don't see a change in your view of risk, right? That's where you're going to have a real issue. And that's what we're working with the FEMA flood maps today, right? Where the hazard's changing, the models are getting better, yet we're not changing our view of risk on that side. And so I think, we're in a healthy environment when we can see changes to the model because we know that the environment itself is changing. And so we should be seeing, updates and differences in the outputs.
And Olivia, sometimes when we talk about change, it could be potentially a reduction in the risk profile and the losses, right? For example, I look at New York City, when I work around the Battery Park, they have invested over $5.6 billion in these flood resilience mitigation measures, flood barriers, portable flood barriers, and so on. So of course, if the model doesn't integrate some of that information, you're going to see a significant, high losses. But if you put that information in, you're going to see significant change in that risk profile. So this is, I think, another way how these models evolved, where you can, the user can go now and say, well, yes, I know this area had introduced, let's say, or updated, for example, the standard of protection for their levees. I can use this model and just go update the standard of protection rather than waiting for the vendor to go and release an update. So there's that. I would say these knobs that now being introduced where the user can go and interact with the model, not only just basically uploading a portfolio or uploading a book of business and trying to understand the risk, but more understanding also mitigation measures and how that essentially changes the risk profile. So it could go either way, if you will.
It's such a key point because we have, leaders from different municipalities reach out to Neptune for these conversations constantly, and it's, hey, we've invested tens, hundreds of millions of dollars in infrastructure over the past X number of years. Why aren't we seeing a change in the flood maps or the price, of flood insurance or whatever it is? And so joining those two dots is so key here, right? What is the investment that's going into infrastructure changes, and then what is the output of the models in reduction of that risk, depending on the level of confidence we put in that infrastructure change. It's so key to the macro conversation around how do we reduce flood risk in the country, and how do we, solve some of the issues around affordability, etc. Right? Because this is where the vast majority of the money being spent is going, and we can point to infrastructure changes in New York, like we've talked about, across Louisiana, across Texas, and so we've got to make sure that that money is being spent in an efficient way that then makes its way into the modeling as well.
Yeah, and I would say it also goes outside of homeowners too. I mean, I think about, we've been working a lot more with utilities lately with one of our sister companies, and we've been having conversations. The utilities obviously aren't the most positively viewed entities in the whole wide world of sports necessarily, but they provide a really vital function. And so what they're starting to do, we're working with CenterPoint Energy out of Houston as an example, and this is fairly public, and they've gotten a lot of money to be able to harden their infrastructure. So as an example, we're helping them say, if you elevate or add a flood wall to this power generating station, you can reduce your risk by X or Y. The mitigation that's coming out of these models is really, really important. So it goes beyond insurance again, just to kind of keep harping on that. This isn't just an insurance problem. And you can use these models, the model outputs that are very sophisticated, to be able to drive outcomes where you're reducing the number of power outages during something small like Hurricane Beryl that came through that caused huge amounts of outages in Houston. We actually know, and these models can tell you, if you're going to do mitigation, this is the best bang for your buck. So that's where, I think, obviously this is more around flood and flood insurance, but just again to say that it goes beyond that. And the nice thing is, if everyone wants to benefit from this, once you're a utility and you do that, you then can actually see reductions in your direct insurance premiums, right? So you can get that buy down, you can get that return on your investment. And these models help you make that decision. So the mitigation is, Matt, and for us both, it's very important, and the models deal with that very explicitly because it's just such an important question.
Absolutely. And this is one where if you go look at a historical map, you could see potentially an area that had repetitive loss, significant risk of flooding, but now you have a, $1 billion, levy that was just implemented. So history here really doesn't reflect of what the risk could look like today.
Great. So in the interest of time, I'm going to jump to a question around the markets. The private flood insurance market in the U.S. has roughly doubled since 2020. But is still only around 10% of total flood premium. The NFIP is the dominant provider and has $22.5 billion in debt to the U.S. Treasury. We have a market structure where the public program is structurally underwater, the private market's growing but small, and the uninsured exposure that Frost just put a $1 trillion number on sits outside both. The question I want each of you to answer is the structure of this market sustainable for the next 10 years, or do you expect it to break? So anyone who wants to answer first, go ahead and jump in.
So I think we're in a scenario where the structure of the market is constantly evolving. And so I think taking a snapshot of it today is somewhat of a difficult thing to do. I think if we look at it, for us as numbers, if we look at it back in 2009 versus today, there's been a pretty significant shift in terms of where that risk lives through two different methodologies. One, through the NFIP now buying reinsurance, right, beginning in 2017. So some of that shifted to private market capital as well. And then through the private flood insurance space. And so I think credit should be given where credit's due as well. I think risk rating 2.0 has provided a lot of stability to the market as well, right? I think there's a march towards more actuarially accurate pricing, and thus you're gonna get to a more sustainable place. But to the point you made, you've got the NFIP has $22+ billion of debt today, and they're paying nearly $2 million a day in interest on that, right? And so the point at which you can take that program to now being sustainable as it sits today, we're nowhere near that now, right? And so how do you continue to evolve the view of risk that lives in the NFIP, but then also complement it with a growing private flood insurance market? And so I think on the private flood side, which I'll just speak to more eloquently here, being sort of where we live every day, there's a lot of demand from a capital standpoint, right? This is not an issue with, okay, the capital in the global insurance and reinsurance market isn't there to protect the risk in the United States. No, that's not the case. It's absolutely there, and there's huge demand. It's how do we generate more knowledge of flood risk, and how do we, get back to this macro environment where there's more mortgages in the United States, and or flood maps, develop to the point where there's more information shared, and there's more house insured. And at that point, you're going to continue to move the market from where it was in 2009 to where it's going to be in 2029, which is, a greater shift towards the private side. And I'm not going to spend any time on it here, but I think there's some really good points and ideas in the FEMA Review Council of how we can continue to shift and evolve the market to get to a point where the NFIP is playing the role that it should efficiently be playing, which is as a sort of backstop or an insurer of last resort within the market.
Yeah, and I'd agree with everything that Matt said. And I'd also jump in and say, just to the question is, do we think it's going to break? I don't think it's going to break. I mean, it's not broken in 40, 50 years. It's not broken after having these big losses. And they've been, the government has been adding in, to its credit, ways of for the private industry to come in and start to fill some of these gaps, as kind of Matt mentioned. I think the other thing too is you think about change, you think about regulatory change, which is, some people like, some people don't like, but I'll just sort of state the realities of what we see. You've got California as an example right now that's looking at, all the uncertainty around the National Flood Insurance Program, that are starting to think about creating their own state flood insurance program. Now, how that's going to live, that's very, very early stages. It's just the rumblings that we hear right now. So you hear that individual states making some decisions around trying to make backstops. If you think internationally, you've got international regulation on climate change. So we kind of skipped the climate change question a little bit about that, but that's regulatory requirements. Say if you're out of Lloyd's in London and you're writing property business anywhere, you actually have to specify what your climate risks are. So it's the PRA TCFD if people want to play with acronyms. And that there actually was, through the NAIC, the National Association of Insurance Commissioners. I worked a little bit with them on this. Was they were creating some legislation to be able to bring the PRA TCFD to the United States. That hits banks, it hits insurance, again, it hits. If you have property, you have to be able to quantify some of your climate risk. Now that's now dead officially in the last years. The SEC was stuck in litigation, and I think in the last 2 months or so, they finally dropped that policy. But then if you go around again and talk to the individual states, California is talking about making their own version. Illinois is talking about making their own version. New York is talking about making their own version. So, it's a story we've all seen before when it comes to regulation. The federal government decides not to do something. Some of the bigger states decide, with bigger economies, decide to do something, and eventually it becomes the law of the land. So I think what we'll see is evolution, as Matt said, of the industry, not a breakage of the industry. And a lot of that's going to come from changes in legal regulation, changes in climate, and just decisions that are made, on large levels that will change the playing field as we go along. But I see things moving more toward the private industry. I mean, at the end of the day, that's where things typically end up anyway. And we're already seeing that that's working quite well, frankly. People are making money and people are getting protected. That's the deal with insurance, right? You pay some money, you get protected. And I think we're starting to see, we've been seeing for quite a long time that's moving in the right direction. So I think the only thing that's certain is change, to use the old aphorism.
Maybe I agree with all these comments, and I think to add to it, I think awareness plays a very key role. I remember after Hurricane Ida, I live in New Jersey, and many of my homeowners, we don't live anywhere close to a special flood hazard area or riverine system or coastal. Many of my neighbors got flooded from pluvial flooding, right? And when I was talking to them, they thought they're not allowed to get flood insurance because they live outside of a special flood hazard area. So I'm really happy when I hear Matt, you mentioned, I think, 55,000 agents that have basically identified within that MFA. I think that's great, because that means this is driving more and more awareness about this important topic, which is, maybe you're not in a special flood hazard area, but you could still be at risk. The premium is not very high. You can just add it to your homeowner's insurance policy, and you buy that peace of mind if something happens, right? So I think this is one where I think that element of awareness is potentially going to drive a lot of that as well, in addition to, of course, the other elements that Brandon and Matt mentioned.
Great. Well, I want to thank you all so much. This flew by. I can't believe we're already at an hour. But thank you all, Matt, Frost, and Brandon. appreciate your time, your insights. I certainly learned a lot. I know everybody who attended did as well. Our next Risky Science Live will be in September. We'll announce the topic and panel by mid-August. I'm Olivia Berkman. Thank you for joining us.
Thank you.